Okay.
I mentioned Bill Baruch buying a stock that's up 60% this week alone. It is ARM Holdings, and he joins us now to explain why. 60% up, you buy it now?
Yeah. I mean, it's about 10% off the high, so I'll take that part of it. But before I dive in why, again, here's the thing: is I'm looking at ARM, and it's all about portfolio positioning. Amazon's our #1 holding. I talked about Tesla yesterday. If you couple ARM and Tesla together, they're about a third in our portfolio, a third of the size of Amazon. But I want to own these names because I think that they could 4 or 5x from here over the next 3 years. Look at the EPS that just came out here. They raised guidance on this report on the lower end of full-year guidance of EPS by 20%. Not only that, we're going to start to see better royalties as their clients switch off the V8 architecture and move into the V9 architecture with better computing. They cover 99% of the smartphone CPU computing market right here. And I just see this foothold getting bigger and bigger. I want to have a piece in this game right now, and I see myself adding if it does go lower.
So a couple things. So you're telling me that none of that, what you just said, is already in the stock, number one. Number two, if the market is ripe for some kind of consolidation, wouldn't this be at the top of the list or certainly near it for stocks that can have a larger drawdown than others because of the unbelievably rapid rise?
Well, number one, I mean, here's the thing: is overall this positioning in this market not being priced in right now, because I think that this name is now on the list of other managers, other funds that are looking to gain this exposure. Remember, they went public when September, October of last year. From there, these names are not getting bought right away. The lockup period for those who own it is extensive, but these names are not getting bought right away. We got through 1 quarter of earnings reports, and then we're getting, this is the main quarter right here. This is what puts it on funds' radars. This is what puts it on managers' radars. So I think now they're waking up to it. The big banks that are managing large amounts of money, they're waking up to that name now. That's why I want to piece into it. But when you talk about the broader market, in the move that we've had in the SPX above 5,000 here, new highs typically lead to newer highs. And that's why here, if we do get a pullback, I think what they've done, what they've accomplished and announced within this earnings report is going to keep this market out above, the $70 and $80 mark. I would love to buy it again and add to this position if for some reason it did go to $80 and $90. I think we'll see it build a nice base out. But the thing is, it may not go down there. And the way I look at this extrapolating in years to come, we're in the early innings of AI. I, at some points, have thought that we were maybe in the middle innings. No, I really think we are in the early first half of AI and monetizing it. What we're seeing here from the hyperscalers, from Apple now, what we're seeing from Meta, of course, Alphabet and Microsoft, they're going to be putting more money into this and pumping into it.
I got you. I mean, one of the obvious concerns is that some of these stocks have gotten 9 innings worth of gains in the first inning. So it's something to keep an eye on. I appreciate you joining us. Bill Baruch, thank you.